China's the second largest economy in the world and famous for the rapid growth it's seen in the past few decades. But since COVID, its recovery's been somewhat sluggish. So are the best days for China behind us? To speak to us about just that today, I've got Dr. Joseph Lai from Ox Capital. You're watching The Pitch, I'm Sarah Allen, and here we go. Welcome, Joseph.
Thank you.
So to begin with, that recovery, should investors be worried? What's happening?
Sure. So post the COVID opening up, the recovery in China has been relatively lackluster. And I think we can put it down to two things. One is that there was not this big consumer stimulus that was typical of almost all economies in the world. I mean, China didn't do it. So that's one. I guess the upshot is that they don't have any inflation problem at all. That's the upshot. And the second is this big property market adjustment, which they have undertaken in the last 3.5 years. The reality was that the authorities thought that the way to future prosperity for the economy or for the country is not by building more and ever increasing amount of apartments in their cities. So they've decided to deliberately deflate the property bubble, which obviously has led to more sluggish economic growth. And that's what's happening. However, looking at the economy today, it looks like a lot of adjustment has already happened. Property prices, depends on where it is, has gone down about 15% to 30%. The amount of new property sales have probably gone down 60 to 70% from the peak, and construction activities has gone back more than a decade, relative to today's relative to history. So a lot of adjustment has happened, and the government has turned to be more symmetry in the actions. So it looks like the economy overall has bottomed. The valuation looks very attractive, and we think it's an interesting time to look for the future champions in that economy.
What are some of the promising signals that you're seeing?
It's interesting, despite the what we hear, the economy is not as bad as actually what it is. For example, if you look at the GDP numbers, it is likely to grow slower, but it's likely to be around 5% in real terms this year and probably in the near future. If we look at retail sales, it's still in positive territory. If we look at exports, despite all the concern of supply chain and what have you since COVID, the reality is this. I mean, they actually have been growing exports, by probably by around 10% a year in recent years. And if we look at consumer metrics like passenger car sales, it actually has been growing at about 9 or 10% a year as well over recent years, and they sell about 27 million passenger vehicles a year, which is by far the biggest car market in the world. So if you look at the overall picture, it's not like the economy is collapsing by any means, but in fact, it is growing slower, and we're seeing various activities just, I guess, traveling slower, but going okay.
So touching back on the challenge property sector, are we starting to see a turnaround?
Sure. Look, I mean, I suspect that a lot of the adjustments have happened already, but it is not likely that we'll go back to the good old days, the go-go days of 3-4 years ago, because the pain has been had by the economy. It's not in the authorities' interest to actually re-stimulate it into this bubbly, scenario. The likely outcome is that given so much adjustment has happened, there will be a level of stabilization, which is more or less what we're seeing, and I think that's overall picture. But we believe that in certain markets, like in the more prosperous cities like Shanghai or Shenzhen or Beijing, and other cities, the supply has shrunk so much that it is likely that in the coming 12-18 months, there will be some sort of a shortage to some degree, I guess, in some of these cities.
Do you see that as an opportunity for your portfolio?
I suspect at the moment that the people are coming around to the idea that the property market is unlikely to be as vibrant as before. But the reality is that because of the contraction of that sector, it's not such a big part of the economy anymore. So even if it slows a bit, it's fine. If it rebounds, it's nice, but it's unlikely to be a driver for the economy. So the opportunity, we believe, is about now because clearly there's been a lot of negativity towards the economy, some with good reasons. But what we think is interesting is to actually look for basically the future champions in these economies. Remember the GFC? I mean, in the US, the whole banking system blew up and the property market collapsed. That was the time to buy the best businesses in the United States. And we believe we are upon a similar, opportunity, particularly in China.
What are some areas that you're seeing as the biggest opportunities going forward?
So we want to choose stocks which are the future of China as opposed to be the past. And also we want to choose these sectors which are not against what the authority want in the future to reduce the risk of regulatory interference. And the third is, the valuation actually is actually very attractive, so that's easy. So these areas are basically sectors in the internet space, in healthcare, in technology. These companies are, these are private businesses, right? At least, private sector businesses which are kicking goals. Doing well domestically, some of which are actually traveling overseas and actually achieving a high level of success. They're remarkable enterprises. Instead of they're investing, literally multi-billion dollars into research development to climb the technological ladder so that they can outcompete their peers. Domestically in China is extremely competitive. They are true market competition. Very few oligopolies there, especially in the new industries. So what they found is that actually those who can do well in domestic China, if they are actually able to compete if able to actually go offshore, they can actually do very well. And we're already seeing examples of that even in Australia. Companies like BYD, the cars they sell outside of China is actually the price is actually a few times that of China, and so it's highly profitable for them to actually sell cars in other countries. We are seeing companies like Pinduoduo start to roll out their business model to other markets in the world. And we've seen it, it's called Temu in Australia, so that's part of Pinduoduo. And again, the growth of that is amazing. There are other businesses doing that, which again is because of the hard work, entrepreneurialism, the relentless investment in research development, which is enabling them to actually outcompete almost everyone else in the world.
What level of exposure to China do you currently have in your portfolios? Do you expect to adjust this in the coming 12 to 24 months?
When China was having a big slowdown 2 years ago, we were actually underweight on our China exposure. Early this year, we've actually increased our exposure quite a lot. The market was very weak, and we saw the opportunity. We have a really high level of valuation discipline for these great companies. When the valuations come off, we see it as an opportunity. So we've already increased our weighting on China, and really, whether we add more to that economy depends on whether we can identify new opportunities which are basically the future champions at attractive valuations.
What's one thing you want investors to understand about China?
Well, one thing that's important to bear in mind is, China is the world's second biggest economy. It's undergone significant adjustments. However, it is likely that the economy will continue to grow in the next 3 to 5 years. The level of wealth, the GDP per capita is still low at about $12,000 per person, way below developed markets, and so the momentum for growth is still there. To be perfectly frank, if one is a betting person, it is more likely, right, that the economy or the GDP per capita would grow from 12,000 to 15,000, 16,000 in 5 years' time than going backwards, right? And so, that's the thing that underpins our optimism to these champion businesses in this economy. We don't want to go to the good old days of, just buying any bank or any property developer to access these opportunities. We want to be selective. And so the thing to remember is, even though there's a bit of concern over the economy, the long-term outlook is likely to be good to really good. and then be selective and choose the right businesses to own, especially now when the valuation is so attractive.
So the future champions, as you mentioned earlier.
Yes, yes, absolutely.
Thank you so much for sharing your insights today with us, Joseph.
Thanks very much.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.